Well, February natural gas futures slid to around $3.60 per million British thermal units, as forecasts for above normal temperatures next week weighed on prices. Meanwhile, the latest weather forecast updates still fail to show any meaningful cold on the horizon. Instead, they continue to point toward broadly warmer than normal conditions across most of the US over the next 10 days, with the 14-day outlook remaining warm as well. The only exception is the eastern region, where temperatures are projected to run closer to seasonal norms, hardly a convincing cold signal. So, generally speaking, the market is heading into the new trading week with a distinctly bearish tone. With the latest weather and demand expectations, the storage surplus dynamic now looks set to widen even further than in my previous outlook. Unless there is a clear and unexpected shift in conditions, it's difficult to see a strong fundamental catalyst that would justify a sustained move higher in the near term. Now, even though it's not something I usually do, I have to concede that the EIA's projection may be on the right track this time. Their outlook points to a bearish phase lasting at least into May, with average prices slipping toward $3.30. What's more, the current futures curve is even more cautious, with spring contracts pricing in levels closer to $3, suggesting the market itself is bracing for a deeper and more prolonged period of downside pressure. From a technical standpoint, natural gas enters the new week under clear downside pressure. The recent break toward the $3.60 area has pushed prices to their lowest levels since late October, reinforcing the broader bearish structure on the charts. On the weekly chart, momentum remains negative, with price trading well below key moving averages. The market has failed to hold recent bounce attempts, suggesting rallies continue to attract sellers rather than signal a sustainable bottom. As long as prices stay capped below the former support-turned-resistance zone around $4, the technical bias remains lower. Immediate support sits near $3.60, a zone that could trigger short covering or a brief consolidation. However, a decisive break below this area would open the door toward the $3.20 zone, which aligns with longer-term retracement targets and the broader bearish narrative. On the upside, any rebound is likely to be corrective rather than trend-changing. Resistance is layered at $3.90, followed by stronger resistance near $4.20, where selling pressure should re-emerge unless there is a meaningful shift in fundamentals. Bottom line, technically, the path of least resistance remains lower for the week ahead. While short-term bounces are possible due to oversold conditions, they currently look more like selling opportunities than the start of a durable recovery. Don't forget to drop a comment, and feel free to buy me a coffee or YouTube super thanks if you'd like to help keep this channel going. Thanks for being here and I'll see you in the next one.